Hi, thank you for joining this video to show EBITDA reporting in NetSuite. My name is Steve May, and I'll be your host today. Just a quick introduction on Terillium. We specialize in ERP across Oracle's three main ERP products, Oracle Cloud, JD Edwards, and the solution we're looking at today is NetSuite. Terillium has been implementing ERP solutions for just under 30 years. We have about 200 full-time consultants across the United States with many years of experience. And we're very proud to have won several awards for our implementations. In an industry where implementations can carry risk, Terillium is very proud to have won several Implementation of the Year awards. We think we're only as good as our last reference and really value our referenceable customers. We've implemented ERP for over 700 clients across those 30 years. Today, we're going to focus on NetSuite. From a NetSuite perspective, Terillium helps companies evaluate NetSuite to determine if it's the right solution for them, purchasing NetSuite to make sure they get the best deal on licenses possible, implementing NetSuite in a way that ensures project success, and then providing ongoing support after the implementation is live. When it comes to NetSuite, we call NetSuite the world's #1 cloud ERP platform. We measure that by number of customers. NetSuite has over 28,000 customers live on its solution. Those customers cover every kind of industry, they're every size, and in all parts of the world. NetSuite is a real ERP solution. As you think of it in the classic terms, it has financials, distribution, and manufacturing. It does have things that you might not associate with typical ERP, like human capital management. It even has customer relationship management with marketing automation built right in. NetSuite has an e-commerce solution that allows you to have a web storefront integrated with your ERP system. That's a real differentiator for NetSuite. And of course, it's multi-language, multi-currency, and multi-country. All of this runs on a single data source supported by the Suite Cloud platform. So NetSuite isn't just a functional ERP, but also the security and infrastructure you need for your ERP system, a complete development platform to customize NetSuite and integrate NetSuite with other systems, and all the capabilities that your users need to do their jobs anywhere your users are. All 28,000 NetSuite customers are on the latest release. That means they get upgraded twice a year to have all of the latest technology. These two upgrades throughout the year do not cause issues with customizations or integrations. Our customers leave the office on Friday, they come back on Monday, they're on the latest release without any consulting support. The upgrades happen seamlessly and all customers get that latest technology. Of course, one of the main reasons customers choose NetSuite are for its excellent reporting and BI capabilities, and that brings us to what we're talking about today. So I'm proud to welcome Kenny Ball to the video here. Kenny's going to show us how EBITDA reporting works in NetSuite. We know a lot of our customers, especially those who have investors or private equity or venture capital partners, need to report EBITDA in a variety of different ways. Some people struggle with how to do this, and Kenny is here today to show us a few different ways that NetSuite can help with EBITDA reporting. Kenny, welcome to our program today.
Thanks, Steve. Yeah, as he mentioned, we're going to walk today just through some EBITDA reporting solutions in NetSuite and what we can do really for those private equity firms that need the reporting back to their investors, and maybe they have add backs to their, maybe they have a one-time legal fee or a one-time bonus for sales or executives. They can typically put that in a separate section on their report so they have kind of their reported financials and then their EBITDA adjusted financials. So today, as we walk through, we're going to go through 3 different methods in NetSuite. You'll see as we go through, they do have some similarities and just a few slight differences. So we have the dimension method, the account method, and the multi-book accounting method. So one commonality between the 3 different methods is that they will all require a slight customization to your reports. But let's jump in now to the dimension method. And what we mean by dimensions is utilizing a native NetSuite dimension, such as a department, class. Those are the 2 most common. You could even use a location. The one thing is there wouldn't be adjustments needed at the end of the period. And you're able to maintain a single accounting book. So you don't have to maintain a primary and a secondary accounting book in NetSuite. And after we go through these slides, what we'll do is we'll go into each method and take a look at, how we would accomplish those in NetSuite. Next, we have the account method. Basically, you would make an adjusting journal entry at the end of the period, and we would make the adjustment account show up in a different section of your financials. You're still maintaining only one accounting book, but what you'll see with this one is that your primary accounts will grow, which is okay. But in your, like when you look at your chart of accounts, you will have an adjustment account for each of those potential sections that you would be adjusting due to EBITDA. And so again, you see some similarities between this and the dimension method. The one main difference is that your accounts will grow and you will have to make an adjustment at the end of the period. And next we have the multi-book method. You will still need to make adjustments at the end of the period. However, your original entry will be kept in the primary book. You can have accounts that are book specific, and you can also create budgets, a lot of pro forma budgets. We see a lot of times in the private equity sector, you need additional budgets. So you could use this secondary book as kind of a pro forma book to make a budget or a forecast. And you can also compare your primary and secondary books. So you'll be able to see where the difference kind of lies between the adjustments you made in that secondary book. So that's kind of an overview of the 3 different methods. Now let's jump in and go through a quick demo of each, and we'll start with the EBITDA dimensions section. So you'll see here we have our income, cost of sales. This is just a pretty standard income statement in NetSuite. I have made a couple of adjustments, as I mentioned, and you'll see that we have our expenses here. So I'm gonna expand these out and just kind of show you what these look like and the different changes that were made. So you'll see down here on the G&A expenses. So we have our G&A expenses in our ordinary income. And what that does is that brings us down to our adjusted EBITDA. The reason this is adjusted here is because we'll see in the journal entry that there was originally $50,000 in legal fees. And so what we did is we broke that out and said $20,000 of it should go down into the adjustments. 30,000 of it should stay in the original section in the income statement. And so what we do here is we have our ordinary income, and then we have our other expenses. And so this is our adjusted EBITDA because we've adjusted these numbers down here out of the top. And so instead of there being $50,000 in that legal fee section, now we only have 30,000 up here and 20,000 down here. So our adjusted EBITDA is going to be $207,431. And then our reported, once we add these back in, gets us down to 175. Basically, it takes these adjustments and subtracts them from this 207. So how did we get to this point? I will jump out into journal entry 85 here. And this was just an entry where we made, you'll see we have our revenue, we have our legal fees, and we have also our payroll expenses. So on this journal entry, we can see that I broke out the $30,000 to legal fees and the $20,000 that were EBITDA adjustments. And I tagged this department on here. And so what I did when I wrote my report, I told the report to show, only the EBITDA adjustments departments at the bottom and all others at the top. So what that did is it showed all these other entries up at the top, and then at the bottom of the report, we'll see the $20,000 and the $12,000 of adjustments. Now, the reason I say this does not require an end of month, end of period adjustment is because this would be the journal entry that we made upfront for the transactions that occurred. So these fees right here, these EBITDA adjustments, we would be able to flag that upon entry of this journal entry or any other, if you had a bill, you could put it there, or an invoice, you could put it there. So this could happen at the time of entry for that specific transaction. And so that's kind of the dimensionality idea. You tag this dimension here, you write your report so that anything tagged with those dimensions is down here in the EBITDA adjustment section, and you end up with your EBITDA, your adjusted EBITDA of 207,431 and your reported EBITDA of 175,431. This is just one accounting book that we're using. We're not using the secondary book in this case. The next solution I wanted to show you was the account method. And so what we'll do is I'm going to go out and show you here in the primary accounts. We added a couple of accounts for adjustments. So when I say that, I mean that when we come out here to the 6200s, we'll see that this one-time bonus is basically an adjustment account. This account here is just going to show up in the accounting book. So this is a primary account that we can use in our primary accounting book. Also down here, one-time legal fee adjustment. Now I said in our PowerPoint that we will have to make an adjusting journal entry at the end of the month. And so why do I say that? This is why right here. So we look at our expenses in the account method, and we get to this G&A, and we can see here that it has a legal fee of $50,000. If you recall, in the previous dimension section, we had $20,000 going to the adjusted EBITDA, and we had $12,000 of this payroll expense going to the adjusted EBITDA. So how would we get to that section on this report? Well, we would have to create a new journal entry. So we're going to go out to financial, make journal entries. And we're going to make this journal entry. So we're going to choose US operations. And we are going to use 6230, which is the payroll expense. We're going to credit that $12,000 because this is going to be adjusted. So 6230. And we have our one-time bonus here. So that's going to go to 12,000. And just two more lines here. And this is the adjustment you would make at the end of the month or the end of the period, just so that you can keep track of the adjustments that need to be made. Now, what you'll see here is that you kind of lose that original entry. So what happens is with this payroll expenses, it will not here up in the section of the report. So let's pull up this report one more time. So once we make this entry here, what's going to happen is this payroll expense is not going to be here anymore. It's going to show up at the bottom. So you slightly lose this original entry because it's taken the $12,000 debit here and crediting with our new journal entry. So we will save. We will go back out to our report. Refresh. So as I mentioned before, we have our G&A expenses. We see that that payroll expense, as I said, it disappeared from up here and it moves down here, which is good, but we just don't know where the original entry came from because there's no way to drill down into that 12,000 up here. We do have our legal fees down here, so our one-time adjustment, one-time bonus. At this point, because of the way the report's written, it looks very similar, if not exactly, to what we did when we used the dimensions. It's just different ways of getting to that end result on this report. And so what we have here is we have these $30,000 again. We have our adjusted EBITDA, this 207. Again, this is the adjusted portion because this $32,000 is not included in this section up here. And so that's our adjusted number. And then if we need the reported EBITDA for, say, GAAP financials, you could use this down here because it's just taking this 207 and subtracting the 32,000 and gives us the 175,431 for a net income for the period. Now, the third method we want to walk through is the multi-book method. So you will still need to make adjustments at the end of the period. The accounts are book specific. So what that means is we can create a new account and we can set it to only be available in that secondary book. So if you look at permissions issues and maybe only certain people should have access to that secondary book, then you're able to kind of restrict them that way by using the two books. The other thing is that the original entry is kept in the primary book, and then I'll show you how to compare the primary and secondary books. So I'm actually going to, for the sake of the demo, delete the journal entry I just made. Because we are looking at the adjusting book. So here we are with the adjustment book. Down here at the bottom, you can toggle from the different books. So you can go out to any income statement. You can choose EBITDA adjustment or primary accounting book. You just have to make sure you have the multiple accounting books set up in your environment. One cool thing about the adjustment and primary book is if there's just any journal entry or any invoice that you want to post to both books, you do that the exact same way. So you'll see here, transactions, financial, make journal entries. If you make a journal entry like that, what it'll do is it will post to both books. So your secondary book still does keep track of what's going on in the primary. One thing is you would go to this make book specific journal entries and you make your adjustments here in the book specific journal entries and you choose to only post to this secondary book. And so if we look in here, I will show you the journal entry that was made in order to get these numbers kind of changed. So you'll see here, I made the entry to the EBITDA adjustment book. And then what I do is I have these accounts 6230.2. I had to use 0.2 because I had already used 0.1 for the primary book. If you chose one way or the other, you could just keep this as 0.1. But we debited that expense account and credited the payroll expenses. we credited the legal fees and debited the legal fees adjustment. And so this looks very similar to the account method, except for the fact that you're using two different books. And so your primary book would remain your book of record, and your secondary book is where you would do your adjustments. Just kind of gives you a little more flexibility. And so out here, you'll see this report looks the exact same. We're looking only at the adjustment book, and we have our expenses here. I'm going to make this a little wider. So we have our G&A. We have nothing in the payroll expenses. Now that shows up here because we only made the change on the secondary book. We have our legal fees. But again, down here at the bottom is where we see those line items that we just used. So that's 6370.2 and 6230.2. So we have our 20,000 and our 12,000. Once again, the report, like I said, looks essentially the exact same. We have our EBITDA adjusted number here because this $32,000 is below. So this doesn't include the add backs. And then once we put these into this data up here, we get this 175,431, which is our true GAAP reporting net income. And so what I wanted to do is I wanted to show you this saved reports and the multi-book income statement example, because I said you can look at these two different reports and say, you know, we have our primary book and our secondary book. And so what we're looking at here is our book one. This would be our primary book that shows everything that is in our GAAP financials. Our book two would show everything in GAAP financials plus what we've done to adjust numbers in the secondary book. And so if you look at this right here, you can drill down into these different accounts and it will show you the difference between the differences in where you kind of made the adjustments in the secondary book. So we can see like these legal fees, you have 50,000 in the primary book, but there's 30,000 in the secondary book, and you're saying there's $20,000 difference. Well, that's because we wrote it to this legal fees in the adjustment book. And so we've got to get that. Basically, that's an add back for us when we look at EBITDA reporting. That really is the end of today's demo. If you have any questions, please reach out to us and let us know. Other than that, thank you.